Hi, Keith. Hi, Sherry. Nice to meet up with you guys finally here. Um, just wanted to kind of reach out to you guys. I finished my plan now, sent it over to you, so you should have that now. But really, I just kind of wanted to address one certain part of it today. Um, the main part I wanted to address today was Aunt Betty's inheritance. I know you guys had some questions on how that was going to be taxed and kind of just what it's going to look like moving forward here. So she left the municipal bonds for Brentley, the preferred stocks for Bailey, and the annuity for Bethany. I'll kind of break those down one by one here so you can see exactly how it works out. So for Brentley, the municipal bonds, they were transferred with a fair market value of 50,000 as of Aunt Betty's passing. She actually paid 20,000 for those, but the good news is they do receive a stepped up cost basis of that 50,000. So Brentley is not going to have to worry about huge gains on those. The other part to address with that is there's going to be no inheritance taxes on those, and the interest is tax exempt on a federal level since they are municipal bonds. Also, you guys live in a state where there's no income state taxes. So essentially, there's going to be no taxes associated with those municipal bonds for Brentley. She also left the preferred stock for Bailey. That had a fair market value of 48,000 at the time of her passing, 1,000 for them. It also gets a stepped up cost basis. So Bailey will get the cost basis of 48,000 for that as well. There's not going to be any taxes due on the inheritance as well. Now, preferred stocks sometimes do pay dividends. The good news is they're taxable as qualified dividends, meaning they get the preferential tax treatment at a capital gains rate. Because Bailey has no other income, she'll actually be in the lowest tax bracket, and therefore capital gains generally do not receive any taxes as well. They'll be taxed at zero. That brings us lastly, if Bailey decides to sell them, again, it'll be capital gains taxes on that. It looks as though she paid 48,000 for them because that's a stepped up cost basis, and therefore anything she sells it for is the gain. But again, because she has no income tax, it'll get a 0%. Bethany received that annuity. It was a non-qualified single premium tax deferred annuity with a fair market value of 40,000 at Aunt Betty's passing. She paid 10,000 for those. Now these are a little bit different than the stocks and the bonds that we talked about before. The non-qualified annuities actually do not receive a stepped up cost basis. So that cost basis is going to stay at $10,000 for Bethany. Also, because she's a non-spouse beneficiary, the deferred earnings are taxable as ordinary income. If she withdraws any before she turns 59 and a half, she may also be assessed on the taxable income. The earnings would be withdrawn first if she's taking out of there. So those will all be subject to taxation as ordinary income until you hit that basis of 10,000, and then the remaining would be tax-free. Lastly, Sherry, you received that Roth IRA from Aunt Betty, worth $100,000. And you had asked me if you'd be able to save that for your retirement. The answer is kind of. It's going to go into an inherited Roth IRA for you. So basically, it's still going to grow tax-free. However, there's kind of two different rules associated with how you have to take funds out of an inherited account. You can either take it out in a 5-year period. That would mean you have to fully take all funds out of the inherited IRA within 5 years of you inheriting it. The option, which is the one I would recommend, is taking an RMD on that amount, a required minimum distribution. The way that that would work is it's based off of your life expectancy, so every year you'll have a small amount that you have to take out. However, none of that is going to be taxed. The one kind of caveat to that is Aunt Betty did do a Roth conversion 4 years ago. That has to be in there for 5 years in order to avoid taxation on the earnings generated from that conversion. So we still have a year left on that. However, taking the RMDs, it's going to space it out where you don't take very much each year. You have a minimum amount to take each year, and that first amount of those earnings. Because when you draw from an RMD, or excuse me, a Roth IRA, it comes out as contributions first, then conversions, and lastly earnings. So that first year you'll take out a small amount, but that small amount will be from the contribution. Forward now, you'll have that growing in that inherited Roth IRA, tax-free. Any RMDs you take from there will be tax-free as well. That means that it can basically last for your lifetime, taking small amounts every year. That's much better than it growing in a taxable account. I hope that all makes sense to you. If it doesn't, please let me know. I want to give you guys that plan and let you have some time to look it over.